Chapter 8, and the course again is the principles of accounting second part, first part, not second part, but we are close to the second part. Is Chapter 8, internal control and cash. This is the last before the last chapter on the first part of the course. The last chapter after this chapter will be accounts receivables, and that's where this course gonna end up. So the cash, what's interesting with the cash? Cash is the most liquid asset, easily convertible. That will be including cash and easily convertible cash. So for that reason, in order to protect our cash, we have to have well designed and develop internal control systems. Before we design this system, we need to identify and define what the internal control is. So internal control is defined as a process which is put in place by the people who control the organization, in this case management, for the reason to provide reasonable assurance that the organization is going to achieve the key internal control objectives. And not only those objectives, but the general objective of the corporation or organization. Most likely you have internal control system in place in your place where you live. Why? Because you want to make sure that your objectives are met. So basically, internal control is going to help you to identify how close you are to your objectives. Are you in the line to achieve your objectives? And if you deviate from the path to achieving your objectives, what kind of action you should take in order to get back to the track so you can achieve your objectives. Internal control objectives, now let's see, that's objective of the company, but let's see what's the internal control objectives. Internal control objectives are, which is under that internal control, is to encouraging efficiency in our operations. So what that means? We need to be efficient. Instead of going back and forth, or maybe it might be more efficient if you go back and forth in your assignments, you have to find a way how you're going to be the most efficient in order to achieve the goal for assignments, to complete the assignments, and second is to get the knowledge, which is going to help you later for your final exam. Preventing and detecting errors and fraud. Now here, as you can see, is we are on the side of the preventing. Obviously, if we go to the detecting, that means we failed to prevent. So for that reason, I personally prefer to spend more time on preventing errors rather than identifying errors and fixing errors. So if you have to spend a little bit more time on the preventing side, spend time on the preventing side. Then you don't have to spend too much time on the finding the errors and correcting the errors. The other thing that internal control system is going to achieve is safeguarding of the assets and records. We already understand that the assets are important for our company to provide service or to sell the goods and items that we have available, but also we have to protect the records. Since our enterprise resource planning system is going to hold all the information about our vendors, customers, purchases, sales, payments, cash receipts, everything. And also the internal control is going to ensure that information which is provided is accurate and reliable. Now, what's happened with internal control and when the internal control was implemented or invented or guided by the regulations? One thing that we have to know is there's always and always something that happened and after that regulation comes. So what we can say, the conclusion that we can make is every time when there's a problem, there's a change in the rules or there's a rules which prevent of that problem not to happen again. For example, I'm going to give you something interesting, which is current. Now, those events that you see on the slides, those happened 20 years ago. Some of them, what will be that? 18 years ago. I'll tell you which one happened 18 years ago, just in a second. But there's a few events which happened very recently, which now require change in the current rules. What they see is what I was listening today on the radio again while driving to Douglas College is about the events that happened last year, if you remember, on the social gathering on the streets last year or 2 years ago, uh, when there was an accident and people, unfortunately, misfortunate people killed, and the event that happened in this weekend in Toronto, when again people were killed. So that's already, so once the problem happened, now the society stand up and the regulators have to come and try to find a way to accommodate the safety in this case or prevent those problems not to happen again. So this Sarbanes-Oxley Act, which was implemented in US, and how that affect our economy here in Canada, is happened because of there's a problem which happened in US, which affect entire globe, and then the regulator have to step up and change the regulations or rules. So what happened in briefly? There are two companies. One was called WorldCom. If you're interested, you can easily search and you can find what exactly happened. But in short, WorldCom was a tech company which providing some certain services. In those services, what happened is they spent a lot of money on the research and development, which by accounting standards that's direct expense. Now they decide not to expense it; they decide to defer it and put it for the time being as an asset on the balance sheet. The implication on the financial statements is the balance sheet assets start growing up. On the income statements, since the expenses are recorded as assets, there's no expenses on the income statement. So the expenses are low, and the company generating nice, steady net income. That company was, her shares were publicly available and traded on New York Stock Exchange. And the investors, what they see is they see that the company is doing very well by generating profits and increasing their assets. 1 year, second year, third year, and in the third year, the company CFO stand up and says, "I'm sorry for the public. We made honest mistake. We apologize, and all those things. There are certain expenses which were not recorded as expenses, so now we have to correct our mistake, internal mistake. We have to correct it." Everybody says, "Okay, yeah, that's the right thing. Let's correct it." The only problem was that mistake was for $5 billion. So when they corrected the mistake, the stock price by 10 o'clock, it's stock option, the stock uh, market opens at 8 o'clock. By 10 o'clock, the the price of the shares was pennies. So that company gone. The only thing is all the investors lost their money. The second thing that happened was Enron. Enron was energy company in US. So what's interesting with the energy company, energy producer in in the US, this is the last thing that you ever think that's going to collapse. Company with which dealing and selling energy. Imagine BC Hydro in BC go to a bankruptcy. How is that even possible? If there any safe business in the world, that will be energy. Anyway, they came to the bankruptcy. They did what they did. Interesting story. You're too early in the accounting to explain with the accounting terms what exactly they did. If you go to the advanced financial reporting, in advanced financial reporting, there's a chapter with the special issue and what the company doing to deal with those issues. So that's what they did. Very interesting, very, how can I say, advanced level of accounting they made. The auditor, of course, closed their eyes, or they posted, but they didn't post it in the proper language, or was disclosed, but in the very small shrift and font on the bottom and here and there. Anyway, the damage was done. The company collapsed, all the pension funds of the big corporation in US gone. Money gone, literally gone. CFOs of those companies, they received enormous bonuses, everything this, but the public was affected. If you want to see the impact of the Enron on the funny way through the movie, you should watch. There's a movie called Fun with Dick and Jane. Let me find you the name, and you can watch it. That with Jim Carrey and Tia Leone, I think. Let me see. Fun with Dick and Jane. And that's exactly about Enron. It's 2005, the movie, but that's in the comic way explain what exactly and how the public was affected by what happened in the real life. That's the movie called Fun with Dick and Jane. Watch it. It's very educational, in the fun way, a movie. And then the regulators step up and they change the regulations by not allowing the things that were allowed before. As I said, every time when a problem happened, the regulator step up, change the reality. So, in short, there was people to be blamed. The public expected somebody to publicly to be punished, and they found one accountant, and they put him in jail. Not in jail, they imprisoned him in the home arrest for 2 years, and that was all. And then the public and everything back to normal until 2008, when the global financial crisis came, second global or third global financial crisis. If Enron was the second, the third one was the 2008, when all the the mortgage market on the or the house market in US collapsed. For a reason which you can see on there's another movie for that. There are two interesting movies on those. That one is documentary, the other one is explain to the actors. Steve Carell is in that movie. It's called Big Shorts. The Big Shorts, and you can see that I can easily say that Christian Bale. It's actually when he first came on the big scene, I didn't like him because he made this movie Shaft. And from that movie, I don't like him very much. But after that, he did a very good performances in this movie, this particular movie. He doing a very good performance as well. So if you're interested, watch it the movie. Again, very educational. Is going to explain to you now when you have some ideas about accounting. Uh, it's going to give you a different perspective. That's the how the movie is called. It's called The Big Short 2005. It's labeled comedy and thriller. I would say it's a social drama or something like that. But yeah, that's the movie called Big Shorts. And that's in that movie you're going to see some interesting phenomena where the people who want to do whatever they want to do have the power to do it the way they want to do it. And nobody is able to, by the power that they have, nobody was able to tell them otherwise. Um, and probably later, if I see you later in the accounting courses, ask me what exactly happened and how was possible. The interesting fact in 2008, that's a fact, that the losses was ginormous. And as if you can see from the movie, the bank exposure was ginormous. We're talking about here billions of dollars exposure to the market and to the losses that they incur from that event. The funny part is, in 2008, if you check the financial reports, none of the big banks which are involved in this event, let's put it this way, reported any losses on the financial statements. In fact, they reported gains and income. When everybody losing money and everybody lost ginormous, people lost their houses, people lost their savings, people lost everything. The big corporation, the big banks, the banks was involved. Deutsche Bank, American banks, a lot of American banks, JP, no, there was two. Lehman Brothers disappeared from the bank industry, and there was another bank which disappeared from the bank industry. But anyway, none of the big banks which are involved in this scandal, none of them reported losses. In fact, all of them reported gain. What they did, catch me on advanced financial reporting, advanced management accounting, and then I'm gonna tell you. So the point is, every time when there's a pressure, somebody's gonna do something in order to mitigate that pressure. And if you watch these big shorts, you're gonna see something very interesting that happened with this particular with the house market, is that people they wanted. In short, what happened is people buy mortgages, right? In order to buy a house, they're going to get a mortgage from the bank. On that time, the credit regulation was very loosened, and everybody can get a mortgage, pretty much. No income mortgage. Because the people who writing the mortgages, the agents would give you the mortgage, they're making commission by giving you a mortgage. So do they do the credit check? Not so much. Do they do this? Not so much. So technically, they give you the mortgage to the people who cannot afford the mortgage, but since the system was loosened, they don't worry too much. And again, the bank wants to make money. That's the bottom line. So they make money. Fine. Uh, the problem happened later when the people start defaulting on their mortgages. Why? Because again, there's no protection, there's no guarantee for income. There's when the industry and the whole um, environment start getting tight on the jobs. People start losing the jobs. When they lose the job, they cannot pay their mortgage. When the interest goes up, again, they cannot afford the mortgage. They start defaulting on the mortgages, and that starts escalating. Now the bank knew about it, and what they did is, even though those mortgages are very risky mortgages, they label it as a high guarantee mortgages, and they transfer the risk out of their books into the small companies, and they even sell it to the mortgages to the small people, investors, because every investor looking for way to make money. Bank get the bad mortgages, label it as a very good mortgages, give it to the investors. Investors invest their money, and then as soon as they invest their money gone. Now the question is how the bank was able to do that. Well, very simple way. There was agencies which evaluate the mortgage and give the mortgage rating on the mortgage. Bank going with the bad bundle of bad mortgages, and they say, "Can you give me a letter that those mortgages are very good mortgages? They're not risky mortgages. They're highly valued mortgages." They say, "No, we can't. That's total. There's nothing here." Okay, then going to another association which give it mortgage rating. Give me that. They said no. Then okay, then I'm gonna go to another one, and they say, hold on a second. How much you want? What rating you want? That much. Well, it's gonna cost you that much. No problem. They pay the money. They give the document that this mortgage, which is a bad mortgage, is rated at the high uh, guarantee mortgages. Highly risky mortgages now are labeled highly guarantee mortgages, and they sell it to the people. That's what they're doing. And in that movie, if you watch the movie, one of the agents, which running one of those agencies, which giving the rating on the mortgages, and no, actually, he wasn't that. He was a different person. He said this: if I don't get what I want from one agency, I'm gonna go and open my own agency, which gonna give me that document, regardless of what you want. So how can this, in order you to understand it, in order you to feel it, to what kind of extent they went on the very high level, is simply this. I'll give you this example. One of the people that I know that living in Sunshine Coast, she come one day to me and she gave me an apple from her garden, and she said, this apple is from my garden, from my tree. It's totally organic." And I said to her, "No, it's not organic." And she said, "Well, it's on my tree. I never put any chemicals. I never put anything. I just doing the right thing." "Yeah, but still not organic." "But I'm doing this and this and this." "Yes," I said, "that's great, but it's still not organic." And then she asked me, "Well, what do you want me to do to be organic?" And I said to her, "Show me the certificate that says this is organic." So the question is, what makes the organic organic? A document that says organic. I believe all of you go to the markets and buying groceries on the market, and you all of you know that there's a regular banana and there's organic banana. But my question is, have you ever seen the document that actually proves that this banana is organic? Or just somebody gonna wrap it with the green label which says organic, and you're just gonna buy it because it's organic? How do you know that it's actually organic? How do you know that the same green label does sitting somewhere out back in the warehouse and just they wrap it up? You don't. Which is the regulator from the Canadian authority that makes sure that those organic bananas are actually organic in meeting the standards that are organic. Do we ever know what is the standard for a certain banana to be labeled organic? We don't. And imagine this, I'm the banana producer. I'm going to the lab, which is going to give me the document that is organic. Well, money are not the object here. My objective is to sell my bananas as organic. End of the story. So I'm going to the lab, they testing my banana, says no, those are not organic. What I'm gonna do? I'm gonna go to the second lab. Going to the second lab, they also say, no, those are not organics. Then what I'm gonna do? I'm gonna open my own lab. Obviously, it's not gonna be under my name, it's not gonna be under this. And that lab is gonna give certificate that it's organic, and I'm gonna sell it all across. So, can this happen? That will be the question. And why those things happen? Because that's how the fraud is created, people. In order to fraud to exist, they have to be three elements. It's called triangle because there are three angles here. First is the pressure. Any pressure. It can be financial pressure. Today, I'm gonna give the people example with you. You also have a pressure. In this course or any course, you have the pressure. What's your pressure? To get the high marks. From where that pressure comes, different story. Society bring that pressure, your colleagues bring that pressure, your schoolmates bring that pressure, the school itself bring that pressure, the GPA bring the pressure, family can bring that pressure that you have to score high. So you most focus on the marks rather than the knowledge. So now what you're gonna do? Since you have that pressure over yourself, you're gonna look for opportunity. What will be the opportunity? Teacher who doesn't pay too much attention. Teacher who looking somewhere else when you're doing whatever you're doing. Teacher who's giving you some form of exam which you easily can find something on the internet or here and there. In the other words, you're looking for opportunity to get what? What you want. To release that pressure. So when the opportunity comes, what's going to happen? You're just going to do the realization. Having this in mind, let's put it in the perspective of the company. Now, you don't know what pressure people have in their personal life. There can be different pressures. But you know that in order they to satisfy this pressure, they have to find opportunity in order to realize and mitigate that pressure. So you as a manager, where you should focus, on which part of the triangle you should focus, which one of those three you should focus. And you should focus your internal control. Obviously, on the only one option, only one thing, opportunities. What do you have to do? Eliminate the opportunities. Literally eliminate the opportunities. Or what I'm doing, what lately I started to doing is, I'll tell you later, not right now. But this is more like a more kind of controversial approach, which I'm require a little bit high level of understanding, not understanding of self-motivation, so you to understand it. But anyway, you as a manager, one day, what you have to do is not one day, it can happen every day. You to start looking how to eliminate opportunities in order not to have a realization. Again, you're on the preventive side, not on the fixing side, not on the identifying what happened and try to fix it. That's what the fraud is. So what's happening again is something bad happened. Company decide to do things which they're not supposed to do. They try to if they that's whatever they did what they're not supposed to do, they affect the entire globe 2 times. Regulators step up, change the rules, cut the opportunities right away. So let's go with the internal control and the component of the internal control and control procedures. So the business can achieve internal control objectives in terms of eliminating the opportunity by crime, that's the acronym of control procedures, implement control procedures, constantly monitoring and assessing the risk, implement information system, monitoring the control, and change the environment or monitor the environment as well. Let's go with the control procedures. Control procedures is going to make sure that the business goals are achieved. We need those control procedures for only one reason, to make sure that the business achieve his goal. What's the goal of the business? To be successful, to generate positive income, positive cash. So in order to do that, we have to prevent all the possible bad scenarios to happen. So we're going to assign the responsibility, we're going to safeguard the duties, so we're going to separate the duties, we're going to use security devices to protect the assets and the records of the company. Constantly, we're going to monitor in the operations and we're going to try to identify the risk and mitigate those risks. Information system. We have to make sure that the access to our information system is limited only to the people who have authorized access. So we're going to give different people different type of access. Also, there will be approval for everything that has been entered in the system, and we're going to keep track of all the assets. And we're going to measure the profit and losses instantly. We're going to monitor in the control. Once we put those control procedures in place, we're going to start monitoring. We can hire internal, we can hire external auditor, we can put the cameras in place, we can do whatever we want in order to monitor and make sure that our control exists. Why? Because otherwise company is not going to meet their objectives. And the last one is the environment. In the environment, we have to create environment that promote ethics and professional conduct. So what we're going to have? We're going to have this ethical standards, professional conduct in the company. We're going to expect all the professionals in our company to act like professionals. And I like this tone at the top, which means, and you're going to see it one day, everybody's going to look at you. If you open your own company, everybody's going to look at you and they're going to wait for you to tell them what to do. And whatever you do, the way you're doing it, that's how they're going to do it. If you dress casually, everybody's going to be dressed casually. If you dress business, everybody's going to be dressed business. If you dress formal business, everybody's going to be dressed formal business. Dress formal business. So everybody's going to look at you. And one day, if you end up to be the owner of the company, your company will be exactly a reflection of yourself. Same thing one day you're gonna have, you're gonna see in the two eyes of your kid who's looking at you. And one day you're gonna ask yourself, when you're looking in the mirror, you're actually seeing your kid. Or when you're looking at your kid, you actually see yourself. So for that reason, environment is very, very, very important. Setting the appropriate rules and giving the right example. It's very imperative. Okay, internal control procedures. The effective system of internal control has to have characteristics: competent, reliable, ethical personnel. People who working with the system has to be competent, has to be reliable, and it has to be ethical people. Then we can assign the responsibility, but that we're gonna assign those responsibility based on their competent level, based on their reliability level, and based on their ethical standards. Which responsibility has to be carefully defined. Which comes to the point of the separation of duties. And separation of duty, I'm going to test you on the separation of duties in form of multiple choice question on the final exam, you to identify what the separation of duty is. The separation of duty is the separate the custody of the asset from the accounting. So basically we're eliminating activity with the recording. Separation of authorization of transaction from the custody of the related authorization of the transaction from the custody of the related asset, and separate operation from the record keeping. For example, the person who dealing with the cash and receive the checks in the company, he's not the one who deposits the checks. And he's not the one who make the journal entry in the accounting system to enter the cash. That's how we create a separation of duty for different activities, different people. Characteristics also include proper authorization. People who are in place monitor the situation, authorizing the transactions, and then somebody entering. Internal external auditors. Internal external audits will be checking from the people inside, people outside. Being internal auditor is kind of tricky profession because technically you'll be most hated person in the company. It doesn't matter how funny person you are, how good personality you have, you'll be the most hated person in the company. We're gonna use the documents and records in order to increase the control procedures. How? By pre-numbered documents, monitoring the records. If we see something that is off the record, bring the attention right away. We're gonna use the electronic devices and computer control to monitor and any other controls. So now, how are we going to control the e-commerce? Now we're going to this category, which you'll be the one who's going to have to deal with the e-commerce. And which is the pitfall of the e-commerce. Those are the computer viruses, phishing expeditions, identity theft, stolen credit card numbers, stolen debit card numbers, anything that can be stolen. Usually, you're not going to identify if something is stolen, you're not going to feel it right away. It's going to take time, and but that doesn't mean you have to stop monitoring and you have to lose your guard, because once you lower your guard, that's where the people is going to strike you. Those threats can result in loss of company data. You can lose control of the sensitive company customer data. Obviously interruption of the business and expensive financial losses. Expensive financial losses related to the loss of data and legal liability, obviously, for the information released. Encryption, in order you to prevent from those e-commerce threats and possible outcomes, what the simple thing is to put encryption, which is a method which is achieved by confidentiality. Rearranging the messages, that's another way for encryption. by the mathematical process, which is monitored by the certain softwares. Put the firewall. Firewall will be the limit access to local network to the only to the network members. For example, Douglas College have the firewalls, which is simply if in order you to use the Wi-Fi in Douglas College, you need to have the access to that Wi-Fi, which is given through your account and through your password. And usually, every system is going to have a several firewalls. Obviously, this course is not about the IT; it's about accounting. It just give you an idea of how different procedures we can have in the internal control in order we to protect the most precious asset in the company, which is the cash. Now, unfortunately, it doesn't matter what you're going to do and how well you're going to do it. There are always ways to people to circumvent or overcome those limitations, which comes to my mind the movie I told them today in the class. Now I can give you the name of the movie with Diane Keaton and Queen Latifah, which is called Mad Money. If you watch that movie, you're gonna see how these people there were able to use collision to circumvent internal control. Actually, I can post you those movies here. That's one, Mad Money. The other one is what was we're talking about the Big Shorts, and we're talking about Fun with Dick and Jane. Very educational. Strongly recommend you to watch them. You won't regret it. At least you can learn something from the perspective of accounting that you have right now, and from the perspective of knowing that Enron is Fun with Dick and Jane. The market crash in US is the Big Shorts. Mad Money is related to collision and how people, two or more people, work as a team to circumvent and beat the internal control system. And you can see that if the people are smart and intelligent enough, it will be very hard they to get caught. There was, which reminds me, when I was a student, when I was sitting where you're sitting, and there was a person talking, was talking to me the way I'm talking to you. He was mentioned this internal control and collision especially. There was a factory in Molson, which factory used to be when you pass the Barrar Bridge going south, on the south out of downtown South Barrar Bridge, on the left side going south, there's a huge factory that was Molson, Canadian. Now the people in that Molson Canadian, they were working together uh, to achieve some goal. What they're doing is they're working on the scam. Pretty much all the key employees, most of the employees were working on that scam. What they're doing is with every truck which leaving the Molson Canadian, there was one pallet, big pallet, unaccounted for. So let's say in the truck there are 21 pallets with beer. On the documents everywhere there are only 20. The 21 doesn't exist. So what they're doing is and that's on every truck that will leaving the company. They were running this scam. I mean, obviously nobody knows for how long they're running this scam because nobody told them, and they're guessing, but they're guessing that they're running this scam more than 10 or maybe 15 years. And they get caught very stupid way. I can't remember what they get caught, but there's some person makes ask question and raise, hey, what's happened with this, and that's how they caught them. But the thing is, nobody knows what exactly for how long they're doing it, what's the damages and anything like that. So that's example of collision. That it gives you this point that even the strong internal control, such as separation of duty, it's gonna fail to protect the company if the people start working as a team. The good thing is with the team is when the money are involved, money are equal to greed, and when the people start doing what they're doing with the money, the greed always comes, and that's how they expose themselves because one become more greedy than the other person. They start fighting, they start conflicts. When the conflicts start, that collision is gone. They're not working anymore as a team. And that's how. Now, for the internal control system, you have to know that the cost benefit analysis has to be done in terms of the system itself is very expensive. Supporting that system is very expensive. Improving that system is very expensive. So the benefits has to be more than the cost. One last thing that I wanted to tell you is this. Some of the students which I'm dealing with obviously ask me, you usually ask me about the profession of the accounting and anything like that. As you can see now from this perspective, you have a lot of opportunities. You can easily mix IT with accounting, and you can be very successful on that path. You can mix, you can work as an accountant on the fraud accountant. I was asked a question from some of the students last, was it last? Yeah, the winter semester. And they say, teacher, what do you think? Can we do the forensic accounting? And I said, yes, you can do it. But there's a problem. And the problem is, if you want to quote somebody, you have to know 2 times more than what he knows. Otherwise, you're always going to be behind. And he always going to pass you. And you're never going to cut him. So the question is, if those people who doing whatever they're doing, spending unlimited amount of time of monitoring, observing, getting information, learning about everything possible, going with the scenarios. And on the other hand, you have a person who barely spending 2 hours of learning. How are you gonna catch those people? They're literally gonna pass by in front of you, and you won't be able to see them. Why? Because they're miles away or faster than you, smarter than you, more determined than you, and they're spending more time studying than. So technically, yes, you can be forensic accountant. Yes, you can catch those things. You can work in a very interesting, highly how can I say? It's not rewarding. It's not going to be a rewarding environment. But you have to I have to be honest with you, because the people who catching those people they know their motivation. They're working for a lot of money. You are on the salary. On the other hand, so your motivation should be highly high, super high. That's why the other thing is in the criminal world, if you're reading those criminal stories and if you're interested in novels, Arthur Conan Doyle and the character that he created, Sherlock Holmes, everybody says it's good that Sherlock Holmes was not a thief. Imagine if Sherlock Holmes was a thief, then nobody's gonna catch him. But he was not. So the same thing with you. If you want to be forensic accounting, if you want to achieve everything in the world, you have all the opportunities. Trust me on this. But you have to work. If you work, if you're consistent, if you're determined, you're gonna achieve everything that you want. And you can do everything. And you can be a great, great, great accountant. With the marks that I saw on the midterm, all of you have a potential. Which brings me to another question. How many of you already signed for next semester for 1210? Go for it if you haven't. If you haven't already applied for 1210, go for it. I'm not gonna teach 1210 in the winter semester. I'm not sure if I'm gonna teach it in the next summer semester. So if you're chasing me, you might never gonna catch me because you won't have that opportunity. I might never teach that course. So go for it and continue with accounting people. That's gonna be the important part for you, and you can make one easy transition from part one into part two. And for those of you who's gonna continue in accounting later, keep going. That's with internal control. Now let's move to cash. Cash. Finally, we came to the point that we're gonna start dealing with single elements of the part of the balance sheet, which is first one is cash. We're gonna start dealing with the current assets and the most liquid assets, which is cash. Cash, what the cash include? In terms cash, when you see cash as a term, means cash on hand, petty cash, cash deposits in the bank and other trust companies, and cash equivalent. That's the first asset that you're going to see on the balance sheet. And often is called not just cash, but it's called cash and cash equivalent. Why? Because again, including treasury bills, which is a highly safe instrument converted into cash. Cash liquidity, that can be considered as a disadvantage because it's most easily stolen asset. Since it's the most liquid asset, that can be considered disadvantage. Why? Because he can easily transfer the hands. Bank account. Let's go with the bank account. Bank account is to ensure that the cash are under control. That's how we're going to use the bank account as a tool to help us to prevent from losing the cash. Every time when we have a cash, we're going to try to put that cash in the bank account. Now, is the bank safe? That's a different question, so let's not go there. Documents which are used for to control the bank account, we're going to include the signature card or cards, access card, deposit slip, which deposit slip is going to be filled and then going to give it to the cash cashier and he's going to transfer the amount of the on the checks into the bank account. Checks. Check is the one that you're going to receive either by mail, either by hand. Bank statement is the one that goes directly from the bank. And you can run even paperless banking. The bank love that one. And when you set up the account, most likely you are set up already for the paperless banking. And the last thing is bank reconciliation. And the bank reconciliation is our key here. But let's go first the check. What's the check? How many of you have never seen check? Is there anyone who never seen check? Is there anyone who never wrote a check? Okay. Uh, it's not big deal. I'll try to give you to share next time with you some check, so you can see how the check is written. Okay? And you can print it somewhere. If you were in a class, I'm gonna print the check, and you can practice writing check. That's not a big deal. But that's something that I want you to at least to try once before you move ahead with your study and your in your life. At least get some experience here to write a check. But check is gonna look something like this. Now, the bottom part is attachment to the check. Only the top part is the check. So the check is gonna have certain requisites which are uh, necessary. One will be the who is the institution or company or person who write the check. Check number, which is consequential order. Date, which has to be filled. Pair and pay in order of. That's where the name of the whoever you're paying the money to has to be written here. Amount with the Arabic numbers. And after that, you have to write down the amount in English as well on the language that you want to communicate in the bank. Then you're gonna have the bank information, which is the address of the bank and branch. And then you're gonna have place for the signature. For control purposes, you can have two signatures in the company. For personal usage, one signature is enough. And on the bottom, you're gonna see numbers. Those are not random numbers. First number here, as you can see, that's the number of the check. 0338 is the check number. Next one is the 5-digit number. 5-digit numbers, that's related to the bank transit number. 3-digit number is bank institution number. After that is the actual bank account. All this information, you can find it on the internet if you want to find it, of course. So what you have to do is the only thing that you have to do is to open once Google search engine and go with the bank institution numbers. Once you click on the bank institution numbers, I'm trying to find Canadian bank institution. If we use this one, for example, here you're going to see the big banks institution numbers. Bank of Montreal, no, code is 001. Nova Scotia, 002. Royal Bank, 003. Toronto Dominion or TD Bank, 004. National Bank of Canada, NBC, 006. CIBC, Canadian Commercial Bank of Canadian Imperial Bank of Commerce, 010. And you have some other institutions numbers. Also, what you can do is, those are all the three digits, as you can see, all the different banks, they have their specific unique number. On that check that we have on the slides, the number was 131. Let's see if that number is going to show somewhere here on this one. Find 131. No, there's no match, so that's a random number. That's not related to any institution. And you can see here, even you have the numbers of the credit union. So that's with the bank institution. So the other thing is bank institution number and transit numbers. This is the image of check. Again, this is the image of check. This is the name of the person, which is random person. Pay in order to, that's where you're paying to whom you want to write the check to. Date, you have to put the date. You have to do the dollar amount in Arabic numbers, and you have to write it down with the letters. Memo if you want to write something to the person who received the check, and that's the place of the signature. Then you're gonna see again, the first one is the number of the check, 001. This check doesn't have number, but it represents 001. Next one is the bank transit number. Second number is 3 digits, bank institution number. And the last one is the account number. I'm trying to find something for you. Bank transit 010, transit 038 if we here. Let me see if this is gonna work. There's a one website that gives you, not this one, here give you the address of all the banks. So if the bank is number is 0010 and the transit number is 30800, that is related to the CIBC Bank, which is located, the address of that one is in Ontario. That's another way you to find the branch of which the banks belong to by checking simply the transit number. Transit number is related to the branch. Let me see if I put transit number 000. And the only thing is CIBC bank location map. If we go here again, it's gonna show you all the bank location and everything that you can find. So that's how you can easily identify which bank account is and where exactly it is. So again, this is the check number. This is the transit number. Transit number, bank institution number, and account number. Okay, that's with the checks. Now let's start preparing bank reconciliation. For the bank reconciliation, I'm gonna go over the slides today. And next time we're gonna practice questions from the bank reconciliation so you can see the bank reconciliation in place. So bank reconciliation is important because there's always difference between the company record and the bank record. Company is going to keep all the transaction in accounting software. Bank is going to keep all money coming in, coming out on the bank statement. At the end of the month, we're going to get the accounting records and we're going to get the bank statement and we're going to compare them and we're going to see the differences. There's a difference between the accounting statement and the bank statement. Now, the question is, why there's a difference? The difference can be for different reasons, because most likely there's a transactions which we recorded in our books, but haven't happened yet in the bank. And there's a transaction which happened in the bank, but not yet in our books. For everything which is in the bank, from the bank statement, we're going to see which transaction we don't have in our accounting books. And since those transactions already happened, we're going to record it in the accounting books. But with for the transactions which are already in the accounting books, we have to wait they to happen in the bank. So once we see, again, there will be differences in the bank statement for the transactions which happen in our books, but haven't happened yet in the bank. For example, if I write a check today, right now, if I write a check to somebody and I put it in the mail, Usually it's going to take a day or two that check to reach the recipient. Most likely it's going to take 1 day or two the recipient to cash the check. So for that reason, for the meantime, that will be outstanding check. So at the end of the month, you may have checks which you send to your vendors as a payment, but they haven't cashed it yet. That means whatever you have in the bank, you can deduct the amount of the outstanding checks because those checks can be cashed anytime. So the question is, if my bank account right now show me balance of $2,000 and I already know that yesterday I sent two checks, check number one, check 11, let's say 11, check 11 for $500 and check number 12 for another $600. The question is, this is no bank balance. My bank balance shows $2,000. I have check. Yesterday I wrote check for 500 and 600, which yet are not cash from the bank. The question is, today, can I write another check number 13, for $1,000? Do I have that much money available? How much money available I have after those two checks are clear from the bank? $900. So if I issue another check for $1,000, that there will be no sufficient funds. Make sense? So for that reason, we have to do those adjustments in our bank balance once we see the bank balance. So again, one will be the outstanding checks. The other one will be deposit in transit. Which one is the deposit in transit? Deposit in transit means I record it in my books as a cash received, but I haven't deposited yet in the bank. I'm going to deposit it tomorrow morning, but I put it in my books today. Now, happen today to be the end of the month. So for that reason, I have to account for those money that I have it in the bank because tomorrow morning, once I deposit there in the bank. And the next thing will be any electronic fund transfer which we receive in the bank, but we don't know from the customer didn't notify us. Those are the adjustment that we have to do in the bank. Now in the books, in our accounting books, what we have to do, everything which is in the bank statement, we have to make a journal entry in the book, in the accounting record. First will be any collections. Again, if the bank collecting any money, we have to put it there. If we have any electronic fund transfer, receipt, and payments, we have to record it in our books. If the bank charges for services or bank fee, we have to record it journal entry. If we receive the interest or bank charges interest, we have to record it in the accounting books. If we receive a check, so watch this. Once I receive the check, in reality, how this works? If I receive the check, if I'm business, once I receive the check, I'm automatically doing journal entry in accounting software. Is it right or wrong? Let's leave it. That's beyond our scope. That's the reality. That's what people doing. Every time when they receive the check, they go in there and they doing the journal entry. Debit cash, credit accounts receivables right away. Then they getting the check, bring it to the bank. Once you bring the check to the bank deposited money in your account. At this point, the bank believe that there's some money in other account from where the check coming from. But let's think for a second. Now the bank deposited money in your account. You deposited the check, the money going to your account. You have the money in the account. 2 days later, when the bank tried to clear the check from and get the money from the other bank tells there's no money in the person account. You're asking for $200, but there's no money. There's no cash in his account. So what the bank's gonna do? The bank's gonna take out the money from your bank account. They're gonna charge you a fee of giving them check which don't have funds, but that's a different story. So the bank's gonna take the money out of your bank account, and that will be insufficient fund check. So what you have to do, you have to adjust your record because you already cleared the accounts receivables. Now you have to bring the accounts receivable back because if you don't do that, you're gonna count that this customer already pay you. But yes, he did. He sent you a check, but he doesn't have money. So technically, he didn't pay you. So you have to bring it back and show it as accounts receivables. Does that make sense? So now, if you decide to print the checks, the bank's going to charge a fee. And if you have any errors in the books, those has to be adjusted. So those are the adjustments that has to be made. So more about the bank reconciliation, we're going to talk next time with examples. Now for the rest of the class, I'm going to go with the other issues that I want to deal with this so we can clear the other issues with the cash to leave only bank reconciliation. Bank reconciliation, we're going to practice next time. The other interesting thing that I want you to talk is the internal control to cash receipts and cash payments. How are we going to do this internal control? Again, having in mind that the cash is the most liquid and can easily change the hands. We have to protect that cash. So first thing that we have to do, if we're dealing with cash, those cash receipts has to deposit quickly. Means cash receipt over the counter, we have to position the cash register so the customer can see the amount. We have to issue the receipts after every sales record. Cash drawer then opens, the person cashier putting the cash in and then closing the cash drawer. Now, once he closing the cash drawer, what's happened is usually the monitoring the system, since the cash register the sales, register the receiving of the cash. Now they're keeping the records. One record is keep on the cash register itself. The other record is keep somewhere in the system. So if the manager, let's pretend we are superstore. In the superstore, as you can see, there's 5, 6, 10 cash registers. Self-check, we don't count it because self-check you have to pay with credit card. They don't accept cash. So you have to go, if you pay in cash, you have to go to the cashier. Once you go to the cashier, as you can see, the machine is pointed towards you, so you can see the total all the time, nothing hidden, nothing like that. Making transactions, posting through the machine, everything beeping, this thing give you the sum, how much you have to pay. So once you give the cash, press the button, cash register opens. Cash register cannot open if there's no there's no total on the receipt. Explain. Shown on the receipt. So once the total is shown and they ask cash how you pay in cash, then boom, press the button, cash register opens. Put the cash in, get the cash out. Now, what they're usually doing is for protecting of the cash, large bills are stuck under the cash drawer, where the regular you have 5, 10, 20, 50, and 100 very rarely, but in superstore they're keeping 50 and 100 under. Why? Not to attract too much interest on the customers. And once again, and you have two accounts. One is on the cash register, the other one is uh, in the management screen. One dot cash reach certain amount, the manager goes there and collecting the large bills. Why he's doing that? Again, protecting the cash. Electronic cash receipts, those need to be monitored daily. All the electronic cash receipts which are sitting on the cash register. Next thing, cash received by mail. If we receive the cash by mail, what we're gonna have? That will be usually we're not receiving cash in the mail. Nobody sends cash in the mail. Even Bank Canada Post tells you don't send cash in the mail. We're not responsible if the cash is lost. So what you're gonna receive? We're gonna receive check. So any incoming mail has to be opened by the person who is in the mailroom. Then you're gonna have the cashier who's gonna deposit the money in the bank. Any remittances advices does go to the accounting department, which the accounting department do the general entry debit, cash, credit, accounts receivable. Control of the company, he's gonna go deposit slip and remittances advices to the day cash received to ensure that they're matching. Some company they can use the logbox system. Logbox system is directly provided by the bank. All deposits are put it in the bank, and company personnel in the bank comes and pick up the box. So in that case, the company people they never touch anything. What's going to happen if we're cash short or over? Now, at the end of the day, what we're going to do, or anytime when we change, even when we change in the cashiers during the day, every cashier comes with his own drawer. Every time when the cashier taking out of the shift, he printing the total from the point that he started until the point that he finished. On that total shows all the sales, credit sales, cash sales, amount of cash that should be in the drawer. So when he print that receipt or that part of the machine of the length, he taking out the drawer and going to the office with all the cash. Next person comes, put his drawer inside, start the machine, start counting. So the person who left the cash register, he going to the management. Management seeing the receipt, how much cash he's supposed to have in the drawer, start counting the cash. If he already collects some large bills, he accounting for those large bills as well and collecting the rest. Now the option is you to have the exact cash, whatever says on that printing, the same thing you have in the cash drawer. Everything's fine. Now the other option is to be short on cash. If you're short than $20, that's a reasonable amount. Usually today, some of my students told me that any amount that less than $20, they don't worry about that. Short and over. So once you check the cash, checking the receipt, the total. If the cash is less than the total, you're short on cash. If the cash is more than the total, you have more cash. So the thing is, if you see that on the same employee for more than 3 days or more than certain amount of days, every single day you have the same amount short or more than $20 short, that's a red flag right there. But that's for the control purposes. For the other purposes is once we do this, then we're going to use for accounting purposes, we're going to use the account which will accumulate the differences between the actual cash and the cash received. And that account's gonna have net balance or debit balance or credit balance. If the balance is debit, that means that's gonna show us expense. If the balance is credit, that's gonna show us a revenue. If it's expense, that means we're short on cash. If it's a credit, that means we are have more cash. If we see again large balance more than $20, that has to be brought to attention right away and need to find the investigation. What's happening now? Now, on the cash short and over example will be you run the register at the end of the day. The register indicates that the revenue is 15,000. That's the cash register shows 15,000 cash. You counting the cash, you're finding $14,980. So what we're gonna do? We're gonna debit cash for 14,980. We're gonna credit the revenue with 15,000, and the $20 gonna go to account which is cash short and over. Since the balance is debit, that means it's gonna be expense in this case. So internal control over the cash payment. Payment by checks is an important internal control. Checks will provide a record of payment. That's why every time when the check is received, journal entry has to be done. Debit, cash, credit accounts receivable. Check must be signed by the authorized officials, ideally by 2 signatures. When you're signing the check, whoever signed the check, he's going to have some supplemental documents under the check to see why I'm paying and to whom I'm paying. Now, for the purchasing and payment process, we have to follow the steps. First, prepare the purchase order, which is sent to the supplier. Supplier is going to ship the merchandises with the purchase order inside what has been received, and he's going to mail the invoice in the mail. Then the receiving department will check the goods, matching with the order which is in the box, and he's going to prepare the receiving report. Accounting department is going to get the purchase order, receiving report, and the invoice. Is going to match all those 3 documents, and then he's going to do the journal entry. Again, company is going to issue purchase order to the supplier. Supplier is going to send the inventory with what has been purchased and shipped. It's going to send the invoice to the company. Once the company verify that the purchase order matching the inventory received and the invoice received, then the company is going to issue check directly to the supplier. Obviously, we can use the technology to streamline this process of the purchasing payment procedures. So system is going to verify all the documents and going to say if there is internal mistake or not. Last thing that we're dealing with the cash is the PT cash. What is PT cash? Every company has normal day-to-day needs. Means that somebody comes, company you providing coffee or providing milk or providing cream and all those things. Now it's not very practical. The accounting department all the time when the person buy milk to issue check for $5 or to $6 or something like that. So for that reason, the company keeps some short amount, small amount. That's why it's called PT. PT means small. Very small amount of cash, usually no more than $150 or $200 now with the inflation. What we're gonna do with that cash? That cash is gonna be handled by one person, who is the custodian of the funds. He's gonna keep the specific amount of cash on the secure location. All the payments will be supported by ticket or voucher or receipts. And what we're gonna do some random check to see if the funds that he has, plus the receipts that he has, matching the amount that's supposed to be there. So, pretend that this company decided to create this petty cash funds to speed up the day-to-day operation in the company. Small cash receipts, anything like that. So, in order to do that, they have to withdraw the money from the bank and put it in the petty cash. And that's what they do. Debit, petty cash, credit cash. Now, every time when the petty cash is used, the custodian is going to prepare the cash ticket and is going to attach the available receipts or documents. At this point, no journal entries are made for any payments from the petty cash until the fund is replenished. What that means replenish is we're going to check what's left. If the funds are close to the end, we're going to check everything and we're going to refresh with another $400. Or going to put the money back so he can also have $400 and keep going. So how this going to work? Replenish, how are we going to replenish? On the end of the month, the PT cash funds hold $230 in cash. So out of the 400, remember we start with 400. Cash on hand is 230. So at this point, how much is we chasing? We're chasing 170. For the out of 170, for 164, he has PT cash, tickets, vouchers, anything like that. Once he combined the vouchers and the funds on hold, that's to end up with $394. For $6, the person don't have any documents. So that means $6 has been spent, but nobody knows for what. In that case, we're going to say, oh, okay, they're missing. So what we're going to do? We're going to create a journal entry. And that journal entry is going to be debit office supplies. For all the expenses, those expenses we already established, those are 164. He has the vouchers. For all the 164, 46, 34, 84, we're going to do the appropriate expenses. For the $6, which is short, we're going to debit cash short and over account. And the difference, $170, we're going to take it from cash. Once we take it from the cash, we're paying all those expenses with cash. So that means the fund balance is going to be back to 400. Because we're not, as you can see, we're not taking it from PT cash. We're taking it from cash. So the fund balance again is going to be 400. And the actual cash will be 230 plus the 770. And that's how we're bringing the balance back to 400. Now, ethical business judgment. What's an ethical thing? Ethical thing is every company has to have some ethical codes to guide the employee how to behave and what to do, what not to do. Most of the employee, they already know what to do, what not to do, but sometimes we have to remind them. Now, the owners and the managers in the company, they can set up a high standards. Also, through their personal appearance and personal act, they can set up a high ethical tone in the company. The accountants, we are expected to maintain that high standards. Now, as a CPA, that's even worse because the CPA is bound, but me as a CPA, am bound by the code of ethics and rules of professional conduct, which is set by CPA Canada. So there are certain things that I can do, and certain things I cannot do. On top of that, as a teacher in the public school, there's another code of ethical standards and rules of professional conduct, which I have to follow. That's for me. But that's how it is. That's how we make sure that there's a professional code of ethics and the people follow that code of ethics on our everyday life. How are we making the ethical decision? Hard. It's hard. There's no right and wrong here, people. But we have to act professionally. We have to assess the situation, determine the facts, identify the alternatives, identify which party is involved in every single situation, provide different outcomes for each of the parties which are involved in the conflict, and then make a decision. What if we cannot make a decision? Then we have to look for help. Who's going to help us? Most likely the professional association that you are a member of, or there's a counselor under that organization. Or if the things are very, very tricky in which the ethical become a little bit legal, then you can look for legal advice here. What exactly to do? There's no recipe here. And again, there's no right and wrong. But you have to use the professional judgment and follow the code of ethics and do the right things. That's for today. So what's next? Next time? Next time, what we're gonna do? We're gonna focus on bank reconciliation. We're gonna do this crazy thing with the bank reconciliation. We're gonna start doing questions. We're gonna practice questions for the bank reconciliation. Then we're gonna practice 1 or 2 questions for the PT cash. And then we're gonna move to accounts receivables. That's what we're gonna do next time. For today, that will be the end.